Okay, let's take a look at this capital structure analysis problem. It's problem 16-9. And I'm not sure how to say the company's name. I'll try it as the Rivoli. The Rivoli company has no debt outstanding, and its financial position is given by the data you see to the left of my mouse here. Book value is equal to market value at $3 million. They have EBIT, or earnings before interest and taxes, $500,000. The cost of equity is 10%. The current stock price is $15, and the number of shares currently outstanding is 200,000. They also have a tax rate that's federal plus state of 40%. Okay, now, given this structure, the firm is considering selling bonds and simultaneously repurchasing some of its stock. If it moves to a capital structure with 30% debt based on market values, its cost of equity, which is given by the symbol R sub S, right, the return required on stock, will increase to 11% to reflect the increased risk. Bonds can be sold at a cost of 7%. The symbol for the required return on bonds is R sub D, and Rivoli is a no-growth firm, so all earnings are paid out as dividends. The earnings are expectationally constant over time, so we don't think they're going to change. Okay, Part A says, what effect would this use of leverage have on the value of the firm? And I've worked a little bit ahead, so let me slide down and show you what I did. The value of the firm is going to be the value of the bonds, or its debt, plus the value of its stocks. Okay, so if we drop those in, they currently have no bonds, and the stocks are equal to $15 per price times 200,000 shares. So the value of the firm at this point is equal to $3 million. Okay, now then we need to determine what would happen if we use leverage. So let's take a look at its current weighted average cost of capital. And I think what I want to do is just bring this to light screen by screen here. Okay, now moving on with this, we then need to use the weighted average cost of capital formula and calculate what the weighted average cost is. Okay, now I've worked this ahead of time, so let me bring it to light and I'll show you. The bonds, we multiply a weight of 0 times the current cost of capital, and since it's irrelevant, we just make it 0. And the stock portion, or the equity portion, is 100% times 10%. And then when we add across, we come up with 10%, right? And that's the weighted average cost of capital. Okay, now let's slide down and do the same thing with our new capital structure with the 30% debt. So now we have a 30% weight, which forces the equity weight to be 70%. If bonds are 30 and stocks are 70, that both has to equal 100, which it does. And then next what we need to do is bring in the cost of capital. Okay, now they told us that due to the added risk of carrying bonds, right, we have to, the risk to the equity holders is that the interest on the bonds gets paid before them. So the firm itself now has leverage, and it's a riskier firm. So the cost of capital rises from 10% to 11%. Okay, and if we multiply that across, we get 7.7 is our cost of capital component for stocks. Okay, now the cost of capital component for debt then is equal to the 30% times the cost of capital, 4.2. Now remember, we came up with 4.2 because the bonds can be issued at 7%, but we have to multiply it times 1 minus the tax rate. So 7% times 1 minus the tax rate reduces the cost of capital, since we're essentially getting a tax benefit because the interest on the debt is taxable. So it reduces it to 4.2. We multiply across now and then add the two components, and we come up with a new cost of capital of 8.96%. Right, now what I want to do is bring the formula in to show you that really we work that weighted average cost of capital formula. Okay, I brought the wrong one in, but here's the right one. And so what you see is we were multiplying the weight times the cost of debt times 1 minus the tax rate. That's this part of the equation. And then we did the equity component. We took the weights, which was 70% equity now, times the 11% required rate of return on the equity. And then we add the two together to come up with the 8.96%. Okay, then the last thing we need to do is determine the value of the operation, the value of the business. And I've worked that ahead of time, but let me show you how we would do that. They told us that EBIT was equal to 500,000. Okay, and if we look at the formula, what we have is the formula for a perpetuity. We have a constant payment, the free cash flow, which is essentially equal to EBIT times 1 minus the tax rate, right? So the earnings before interest and taxes. Then we have to subtract off that portion of earnings that goes to Uncle Sam. The balance becomes ours, so 500,000 times 1 minus the 40% gives us the top part of that perpetuity formula. The reason it's a perpetuity is we're expecting the business is in steady state. All earnings will be paid out in dividends, and we don't expect the earnings to either rise or dividends to rise. So then we divide it by the new weighted average cost of capital given in cell C44. And when we do that, we see that the value of the firm rose $348,214 to $3,348,214 from $3 million. And that takes care of part A, which asked just at the top of your screen there, what effect, let me slide up just a little bit, what effect would this use of leverage have on the value of the firm? Well, it increased the value of the firm by $348,214. Okay, next, take a look at part B, which says, what would be the price of the company's stock? All right, let me slide down. Now, the easiest way I know how to do that is simply take the value of the firm, divide it by the number of shares outstanding, which was 200,000 given earlier. And once I turn that into a regular number, what we wind up with is the price of the stock would rise up to $16.74. And before, we simply took the $3 million divided by 200,000 to come up with a $15 per price, right? $15 was the stock price. Now we're at $16.74. Okay, now I've copied in another approach where you could see that to derive that $16.74, you could also use this approach where we say the value of the debt then is equal to the weighted average of the new value of the firm. So 30% times our new number of 3,348,214, right? That's that number right there. Says the value of the debt was equal to $1,004,464. Okay? If that's the case, then the value of equity is the difference between that 3,348 and the 1,004. So it comes out to be 2,343,750. And we could compute the new price by saying, take the 2,343 plus the value of the debt, 1,004, dividing it by 200,000 shares. And you'll see that we're essentially arriving at the 1674 as well. Okay, now I've slid up a little bit so we can read part C, which says, what happens to the firm's earnings per share after the recapitalization? All right, well, the new value of the business is equal to $3,348,214,000. Let me state that again. The new value of the business is equal to $3,348,214. Okay, now, if we want to determine the value of the debt, and we need to do that to figure out how many shares we're planning on repurchasing, right? We would need to take that $3,348,214 times the 30%, and that gives us the value of the debt. Then if we divide the value of the debt by the new expected share price. Okay, so I'm going to drop in that 1674 there. Format that. and I come up with an answer of 1 million, value of the debt, 1,004,464 divided by 1674, what I come up with is the number of shares, the number of remaining shares, excuse me. The 60,000 represents the number of the shares that are repurchased. So the number of remaining shares would be equal to the 200,000 less the 60,000, right? Or 40,000 up, and once I put the right number of zeros in there, we'll calculate the 140,000 remaining.